Welcome to the PFP podcast from the Personal Finance Society, a place for thought-provoking discussion from the world of financial planning and beyond. I'm Matt Connell, Director of Policy and Public Affairs at the Personal Finance Society. Following last week's spring statement, we look at how that and the budget in November impacts the work of financial planners and paraplanners. We will also look at the additional pressure caused by recent events, including regulatory changes. Joining me today is Sam Paterson, Head of Proposition at Equilibrium Financial Planning and member of the PFS Power Panel, and Phil Greenwood, Head of Technical Consulting at EQ Investors and member of the PFS Paraplanning Panel. So thank you both for joining me on the podcast today. I think we'll start off, it's been quite a journey over the last 5 or 6 months. Maybe, Sam, if I can start with you. So we had the budget announcement in November, a lot of excitement in the run up to that. What's really come out for you in that budget, and what sort of additional things have you discovered along the way over the last few months around that budget in November and the decisions that were made?
I think the budget in November actually started in August. It felt like we just had months and months and months of speculation. The budget that's normally at the end of October actually happened in November. And then we had the whole bombshell of pensions coming back into the estate. We had AIM business relief. And it's just been a lot of questions from clients. It's sort of a bombshell was dropped, and with no real substance behind it. A number of sort of changes in tax since that budget as well. So it's been actually quite nice to have nothing really new in the most recent budget, in the spring budget. I know there's sort of other things topically in the news that actually, if there was any big announcements, it was never going to go anywhere. But for us, it's all been about pensions, inheritance tax. That is what's coming up with clients, understandably. It's been the biggest change in over a decade. But we all know that actually for our wealthier clients, and majority of clients actually getting financial planning advice, pensions sort of turned into an intergenerational tool, certainly for some of the bigger clients. And we're all aware that actually in a little over a year's time, what was the most tax efficient investment to pass away with is suddenly going to become the least efficient. So that's been the whole topic of conversation since the November budget. And I'm sure I'll speak on behalf of the whole entire profession, which is just give us some meat to the bones, tell us what actually is going to come in with that. But that's something, we'll certainly wait and see over the next few months.
Absolutely. And Phil, has that been the story from your point of view as well? Those changes and the need for clarity behind them?
Yeah, it's been dominated by the IHT changes to pensions. Absolutely. I agree with the comment that Sam made on the speculation. Very unhelpful. Lots of people taking tax-free cash when they didn't need to, that sort of thing. So that's not been very good, really, from that perspective. But the budget there's quite a lot of small sort of tweaks that have been made, around things like savings tax and dividend tax and agricultural relief, business relief. There's lots and lots of small changes that go along with the pensions and IHT. And I think when you pull it all together, it's caused quite a lot of confusion, I think, as to what the best solutions are now. And we're still sort of talking through those. And and Sam said there's still stuff being changed. The cap, I think, that was announced in 2024, actually. That's now been changed since the last budget. It's going up to 2.5 million, I think. So there's things like that which are coming in. Clarity needed on the pensions and IHT. I think there was some news around personal representatives being allowed now to instruct pensions administrators to retain 50% of the pension assets, which, so all these like mechanics, which are going to be really what we now need to know. How is it actually going to work? And I'm not sure how we're going to work through it in time, to be honest. But that's the job.
Absolutely. So Sam, do you think perhaps the spring statement then, you mentioned that there wasn't a huge amount of substance in there. Do you think there was a missed opportunity to provide a bit more clarity around some of these questions?
I don't know, really. I've been debating it both ways. In one way, I think there was certainly a missed opportunity, but with the sort of level of detail the profession is sort of crying out for. Is that right for a budget? I'm not sure. I'm not sure many MPs would really actually engage with that. And actually, is it a bit too detailed? I think what we're really crying out for is some, I think HMRC did a consultation which closed last month on the pensions. So we'll wait to see the detail from that. I think from the spring budget, what was mentioned overwhelmingly was we're on the right track. They keep saying we're on the right track. Whether you believe that or not, they keep saying we are. But they also kept on saying how the pressures on young people and Plan 2 student loans are massively in the news at the moment. They are everywhere. It's been in the press, financial press, but also sort of broadsheets. It's been brought up at Prime Minister's Question Time. So maybe I was slightly surprised to not hear anything put there. But was that just good politics, actually, from Rachel Reeves going, if I make a big sweeping announcement to change Plan 2 graduates' lives potentially at the time of the Middle East conflict, maybe she just doesn't want to muddle the water. But that was probably the only thing that I was expecting to maybe have some comment on, but there wasn't. I think they did a great job beforehand, is sort of letting everyone know this wasn't going to be an exciting budget. It was all about fiscal. It was all about the economics. A lot of OBR forecasts, which are always right. Sort of sense the irony in my voice there. But yeah, I think the only thing I think they missed, of my perspective, was they keep saying how the next generation are being hit with financial hardships. It's tricky, but there's no real substance again about that. So that's the only thing I think where an opportunity was certainly missed.
Definitely. And any sense from you, Phil, about missed opportunities? What would you have put in there?
Yeah, I mean, it's difficult, isn't it? Because I think it's actually quite nice for it not to be a big surprise, that there were no surprises in the content. They made it very clear, as Sam said, that this wasn't about policy announcements, which is good. And I think the timing was rather unfortunate in terms of forecasting anything, with it being a couple of days after the war started. So how much you read into those forecasts, they've probably changed quite a bit since. I mean, the only things that I could think of really, again, I'm not sure if it's really sort of relevant for the spring statement, but talking about sort of the advice gap and the targeted support coming in. So maybe they could have addressed that and maybe even provided some additional help. I know there's some issues around some of the engagement rules for the pension providers, especially in workplace pensions. So maybe building in more support around that so they can more easily actually contact the people who need the help. And maybe, in the similar lines, I think there's quite a lot of concern around if firms that do engage with this new initiative being, retrospectively penalised by the FOS. And there's a lot of uncertainty around how that's going to work and how the FOS are going to view some of this sort of targeted guidance. So I think maybe some clarity around some of that would have been nice. Again, as Sam said, I'm not sure it's necessarily the right forum for it, but that's what I think.
No, I think those are really powerful. So basically, we had a lot of fiscal change in the budget that caused a lot of confusion, but there's a need there, particularly, I guess, hearing from both you, Sam, from you, Phil, for a bit more structure around what we can do for for coming generations around their financial security and independence. I guess if you were the Chancellor, Phil, what's the one measure that you'd have brought in?
I don't know. I think I probably would have quit by now. I really think it's a horrible job. I wouldn't want it at all. But I think there's a lot of talk around encouraging more people to invest in the UK, and I think there's an FCA initiative on this. But I think it does need help and support from the government to really make a difference. We have a high amount of cash savings in the UK compared to other countries, and I think that just means that people are missing out on long-term growth, really, and the economy is missing out as well to a certain extent. So they brought in the reduction in the cash ISA allowance. Not convinced how much impact that's really going to have. I think you need more of a shift in behaviour rather than like a structural restriction on cash. I think I'm not sure that's really going to impact that much. So I'd like to see more around how they're going to sort of shift that behavioural bias towards saving rather than investing.
Yeah, and do you think the government's sort of using the expertise that exists in the advice profession sufficiently in that, or are there other routes they need to take? Or
I think it's probably, I think reiterate, it's a tough job, isn't it? You have to balance a lot of different opinions and voices and outcomes. I think, there have been consultations on various things, especially around the pensions and IHTs. I think, and there's action off the back of that. So I think, there is an element of listening. It might have been nice to have listened before enacting sweeping changes without knowing how to actually implement them. But, I think there is an element of listening, but the outcomes that the government are after are not necessarily the same as the profession in general.
Wow, fascinating. Sam, from your side, if you were standing at the dispatch box, what would you be saying?
Yeah, I sort of echo Phil, which is I'd like to do anything but doing that, I'd imagine. It's a really tricky one because in the spring statement, they actually said our finances, the company's finances are improving. The forecasts look like they're getting better. We're building in that headroom that's constantly talked about. Stop anyone on the street and ask how you're feeling. I bet they wouldn't say the same thing. Ask our clients, how are you feeling? Look, the country's finances are improving. Do you feel that? I don't think you're going to get that answer. So it is a really, really tricky situation, certainly off the backdrop of the past 2-3 years with cost of living and where inflation reached. I think as soon as the sort of feedback from clients, as soon as the news about the Middle East and the conflict there, it's inflation, which is what's that going to do to my mortgages, which we finally started to see mortgages coming down below 4%. Look, 4 years ago, that was the norm. So to try and actually tackle that landscape, I echo completely what Phil was saying just then, which is actually I'd love to have a common sense approach. It's a tricky one, isn't it? Because as a profession, we do this day in, day out. We know the details. We speak to the clients it impacts. We'd love to have a greater say in actually this policy creation. Having said that, would they ever do that? And no matter how much we'd like to, probably not. But I'd love to engage more, as Phil said. There's certain rules, the cash ISAs over 65, which are different to under 65s coming in. How that's going to work, we have no idea, apart from it's different for over 65 and under 65. And again, I echo with Phil, it does sort of feel the government are looking for the outcome and not building the foundations. It does need a behavioural shift, but it also needs to shift more. We have to engage with the next generation. We have to engage with working people now. And when I talk about common sense approach, I would love to sit down with Rachel Reeves and say, in 20 years, 20, 30 years, the biggest financial asset most people will have is a workplace pension. Those are the pensions now that you can't actually add an advisor charge to. So, and we are, whilst I've never met anyone in the financial planning profession that hasn't come into the profession to help people, to help Mr. and Mrs. Smith, to help the average, the real person off the street. We are a business, we are working, and we do need to be remunerated for it. But this is the common sense approach. The biggest asset that the next generation will have is an asset we actually can't get remunerated on. And that just doesn't make much sense at all. So that's sort of what I'd like to say to the Chancellor, and sort of, I think every financial planner would love to actually felt like their voice was heard a bit more than sometimes it can feel.
Yeah, I think that's a really powerful point. You've got one hand tied behind your back if you can deliver the best quality financial advice there exists in the world, but can't be remunerated from the main financial asset.
And it's not just about remunerated. I don't think any client would ever ask us to work for free, and therefore they would want us to be remunerated. The issue is, at the moment, to try and charge the workplace pension, the client normally pays it directly, and that's out of their net income. So it's after they've paid tax. Whereas if you take it from the pension, it's before that, it's from the gross asset. So again, this is where, whether it's with the financial planning profession or whether it's the FCA, that's avoiding foreseeable harm, surely. It's in line with what the FCA is saying about consumer duty. So it's those sort of common sense approaches, whether it's PIMFA, whether it's the FCA, but I certainly think there could be closer collaboration between both our financial planning profession and the government.
Absolutely. No, really, really powerful points. Thanks. I guess you both mentioned now the impact of the war and kind of relentless headlines, and every other news alert is inflation or stock market sliding. So from your side, Phil, how do you sort of break down all the impacts of this conflict as we learn more and more about it, and start putting it into a narrative for clients?
Yeah, I think there's precedent for this sort of event, I guess, if you want to call it that. And I think there's usually an initial shock, which I think we've seen. Although I think the initial response was quite muted actually to the oil and gas, but since accelerated pretty drastically. I think the general message is these things cause shocks and will cause spikes in prices, and then they do actually usually quite quickly revert as people you end up finding solutions and gaining some confidence, and the impact gets lessened as you go. But I think that's probably going to be the general message again, is short-term impacts. Don't panic. I guess it's very difficult amongst all the noise. We have even today, I think we've seen oil prices at the highest since 2022, I believe, and G7 meeting to discuss solutions. You've got all sorts of rhetoric out of the US, which is decidedly unhelpful in bringing any sort of quick resolution to this. It's going to be a continuing impact, and it's difficult. I think the threat of inflation, as you said, in the news again. This is again news. They love pumping out negative stuff, but banks are already increasing mortgage rates. Interest rates are unlikely to be cut, as was expected. It's pretty precarious at the moment, but it's short term. Hopefully, I guess for planners, planners, it's providing that peace of mind and reassurance, reiterating investment time horizons, objectives. Maybe getting the cash flow planning out, doing some stress testing, looking at historical context, anything to just reassure, I guess, amongst all of this short-term kind of increase in volatility and uncertainty.
Brilliant. And Sam, is that the message that you're giving out as well? Or this is something that will pass? Because I guess what people will be saying is, well, kind of when the war in Ukraine started, we didn't expect our mortgages to be going up for as long as they have, and for the effects to be so long. So are you saying this is different? This will pass a bit quicker, or are you giving a different message?
So I think it is slightly different from the Russia-Ukraine war. That was more gas, which Europe were very dependent on. Oil is slightly different, which is what the main impact that the Middle East conflict's having. Just before this, so for context, we're recording this on the 9th of March. The price of oil, a barrel of oil has increased from $71 to, or every headline today is $100. We see that in the press. Clients see that in the press. So I think my first comment would be planners, paraplanners, be proactive with your comms. Don't wait for the questions to come in. Actually be proactive about it. Send out an email, get a bulk newsletter if you've got the facility, but be proactive with it, because actually I think you'll save yourself time. You'll be able to answer questions before the questions start filling up your inboxes, the telephone lines. More sort of broadly, actually, on the impact on markets, I don't know if it's going to be shut. The thing that worries me most is actually I saw something today that actually says the region that's been most resilient to this is the big US stocks. So actually the area of the investments that if you asked 10 financial planners, paraplanners, what's most overvalued asset class, they'd probably say big tech, big stocks in the US, but yet that's seen now as the safe marketplace. So the reason why I think we have to be careful with the stories we tell to clients now is if we think the data doesn't back up the valuations the US currently has, but yet that's what's performing well. You've got to have a really strong, succinct message about your investment decisions, because I don't think anyone listening to this would agree that clients should drive our investment decisions. So it's just got to be really strong with the rationale. Why are we favouring different asset classes? And if it is still holding a fair amount of US, just making the clients aware actually of this overweight position that is starting to develop. So it's, look, as Phil said, we all know in this profession you should invest in line with your time horizon. I think what Phil mentioned there, cash flow planning is an excellent time to get cash flow planning out. Will this sort of correction impact you in the next 1, 2, 3 years? Potentially. 30 years it might just be another blip. So it's just, again, reinforcing clients about the longer term picture. But a great way we're doing is being proactive with their conversations with clients, with communications with clients, because it can help to settle the nerves before it turns into something bigger.
Absolutely. No, very, very sage advice. To just bring Phil in very briefly, Phil, Sam mentioned sort of proactive measures. Are there any proactive measures that you've taken on this one before questions start coming in, or did they start coming in from day one, preempt your efforts?
Yeah, I mean, I guess kind of lucky that in my company we have an investment team who are doing all the investment analysis. So they've actually sent out a newsletter, as Sam said, pretty early on this, and we are sort of keeping it people up to date on bulk, if that makes sense. I think there's proactive comment is a great one, and I think that is exactly right. I think there are some clients who are going to just be able to ride this out because it doesn't impact them in the short term. I think there are other clients who, probably slightly more vulnerable, are taking income out of their portfolio. Who, if you think about things like sequence of returns, there's potential impact there. So I think they probably need a little bit more analysis and work on an individual level. So I think there's two angles to it. There's one, just general messaging, which is, probably the don't panic. This is what's happening. This is why it's happening. That sort of thing. But on an individual level, I think there are going to be some clients who will need, a bit of individual analysis, and hopefully that will bring around some reassurance. Probably most people probably don't need to change their plans for this, but it is possible that you might need to have a look at that, or they might feel like they need to do something. So it's worth having conversations.
Absolutely, yeah. And looking forward to sort of the wider conversations that people are having in this sort of social media world. We know that on the regulatory side, the FCA's recently put out its first ever Consumer Investments Priorities Report. So this is what's replacing the old Dear CEO letters that were maybe a bit more serious and a bit more finger wagging. And these ones are more upbeat, I think, more looking at the sector as a whole and what can be done to engage with consumers on these issues. AFCA said it's going to publish a guide for influencers to promote accurate, responsible content. So I guess what would you guys be putting in guidance for influencers, particularly over this turbulent time?
It's tricky. Whether I would love to actually have a conversation with a influencer and ask, what is the difference between you and a financial planner? What is the difference between you and someone that's achieved their diploma or the chartered, or someone that's actually gone through the regulations? And I'd hope they would be able to actually explain what the big difference is, because we all know the big difference actually is a financial planner is authorized to give their advice. If the advice isn't ever correct, the clients have protection. That's not there with influencers. And just taking the word influencers, it's financial influencers. They are there. They're being looked at because they can influence people, the content that goes out. So from a regulatory perspective, it is a really tricky space. Something I'd like to see, I'm not sure how this would be done, but paid advertising. What are they advertising? Why are they advertising it? Because that's where the potential for harm could really come in, I think, for clients, for customers, for people who are looking at that content. But it's good it's on the FCA radar. I've sort of speaking about sort of the next generation, people in the 20s now. They've grown up with crypto. They've grown up with NFTs. They've grown up with assets that actually a decade ago never existed, or certainly weren't mainstream. So I think it's good the FCA is now on their radar. I'd love to actually look at paid advertising with influencers would make me really uncomfortable. And certainly, because I think it needs to go more than just this is not financial advice as a little takeaway, which is what it is currently. I'd love to see, again, influencers go through the education process of what the difference is for them and a financial planner, and actually what they can say and certainly what they can't say. And then we need there to be penalties if anyone ever crosses the line, because are influencers impacting the traditional financial planning client? Probably not. Most financial planning clients are normally in their around retirement age, or certainly in the sort of middle age to later on in life. But who influencers are going to really impress upon are the young minds, the young people that are still might just see a get rich quick and not understand actually if it's too good to be true, it probably is. So that's, I'm glad it's on the FCA's radar. It's really to see what the actual advice and what stance they take on it.
Brilliant. Any thoughts from you, Phil, on that one?
Yeah, sure. I mean, I completely agree with everything Sam just said. I think it's impossible to ignore the sort of rise of the influencers and the impact and reach that they have, actually. And it is, as Sam said, beyond the sort of traditional advice clients that we're used to dealing with, which is, I think, it's actually a really positive thing in itself. It's just how it's handled, and again, I'm glad this has been looked at. I think it's quite difficult for firms to operate on social media in this way, because it's dominated by personalities. People on social media, they don't follow companies. You're not really likely to follow the company. You're following a person because you engage with that person. And I think it's quite difficult to be that kind of engaging, organic kind of personality and still fit the company mold. I think people might see it as sort of disingenuous, biased, or not impossible, but I don't think it's that easy for companies to kind of crack that market in general. In terms of the content, going back to that question, the content around guidance, I see this as sort of like there's quite a lot of areas they could go into. One of the main things is going to be around protection of these people and from taking sort of inappropriate action, I guess, based on what they see and hear on social media from these influencers. So things like transparency, so clearly stating that it's educational information and it's not advice. I know there are sort of disclaimers and things like that, but I think there needs to be much more sort of integrity around that and being very upfront about the fact that this is not necessarily going to be suitable for you. This is just general information for you. So that's a big difference, Sam said, between someone just giving general information and giving personalized advice. So, and I think, I think the guide really needs to focus on the responsibility of the influencers and what they are trying to achieve and where the line needs to be drawn. So things like, I've seen quite a lot of these people doing investment recommendations, so specific investments. That needs to stop. We just can't have that. You can't be giving recommendations out. And the reason they're doing that is best ambiguous. These are obviously worst case things, but things like guaranteed outcomes, like you're guaranteed to get a certain return and things like that is extremely misleading. But they've got that influence. I don't think there's enough clarity from these people on the risks that are involved. I know we're kind of going a little bit the other way sometimes, saying we're scaring people off investing, but we also need to be very clear on what the risks actually are. And they should be encouraging people to seek professional advice, like individual advice. Not everybody needs that, but really, it needs to be kind of like a gateway almost into advice, like being able to push people in the right way. And definitely, as Sam said, any paid promotions, things like that, affiliations, incentives need to be very, very, very clear. So those are the main things I think should be focused on. I'm sure there are lots of others, but really, really good to see them looking at that there.
Just sort of following on from what Phil said there, it's hard just because as you say finfluencers, I'm sure most people listening might think, oh, that's negative. But actually, what do finfluencers do? Well, they engage with the next generation and they are giving a form of financial education. It's what we are saying in the profession that we know we need. You see the stats that 8 or 9% of UK adults have a financial advisor. It's not high enough. So actually, as I think finfluencers is in the mold, it is looking positive. It is a form of financial education. And actually, I saw one the other day that popped up on one of my social media accounts, and their content they're putting out is every week they are showing their stocks and shares ISA of about £20,000. This is where it's invested, and this is how it's performed each week. Now, what I actually liked about that, and I'm actually being quite positive on it, is it went down. And they said, don't panic. They're starting to build it. This is what investing does. It goes up, it goes down. Don't get too excited on the positive. Don't get too down on the negative. That's the sort of content that actually I think every financial professional would love to see more of. Educating clients on the pros and the volatility that comes with investing. I think, as Phil said, if an influencer comes up and goes, it's all positive, it's only green, everyone go for silver because it had a great year. That's what makes me really nervous, because they're just putting out a headline figure. They'll grab the algorithm, get pumped out to loads of people, and then there's no one to fall back on. Clients at that stage could be negatively impacted. But the sort of content about the financial education, I absolutely think is a great thing for the profession and actually the wider public as a whole.
Absolutely, and I guess that's been a theme, that we're in this sort of changing world. The generation that's coming has got auto-enrolled pensions, huge DC pots that might be worth more than a house. They might not even own a house. Equally, they're going to be getting financial information from lots of different places that previous generations didn't. So I guess to wrap it up, I guess just invite both of you, perhaps starting with you, Sam. What's your feeling for the next generation? Do you have hope? You're an optimist or a pessimist? What do you think is going to happen in terms of the financial well-being of millennials, Gen Z, and beyond?
Oh, that's a great question. But I think if I had the full answer, I should be standing at the dispatch box instead of Rachel Reeves. But look, I'm an optimist. I think, whilst it's easy to concentrate on the hardships of the next generation, it's easy. So I was born in 1993. You look at the average wage growth and the cost of a pint since I was born, there's only one winner, and it's not the wage growth. Having said that, though, we know we're constantly aware of the great wealth transfer. The reason why I'm also so optimistic is there is such a level of information and knowledge now that is available to us. I do think, though, that there needs to be a level of clarity given. The first question was about the budget. It does feel like every year there's a different budget, there's a different change in tact. Pensions, the longest term asset, is changed. Two major changes. First in 2015, the next last November. So these are assets that we are a long-term saving. Now, I might not retire for another 20, 30 years. Do I think my pension, the rules that impact my pension now will be the same? Absolutely not. And this is where actually whilst I am optimistic, there does need to be a long-term view taken. We can't have flip-flopping between different governments and changing the rule book essentially every 5 years. So I think that's what I would really question from our policymakers, is actually just having a cross-party decision on major financial impacts that impacts the everyday people, because that's what we rely upon. Something, again, just as a closing sort of thing from me, which is student loans are coming up all the time from clients. But to try and, if a client says, should I pay off my child or grandchild's student loan? It is an impossible question. It is just impossible. And actually, that's not even considering the political uncertainty and maybe the chance to change as well. So whilst I'm optimistic, I do think we need just a longer term view on our finances and actually have a greater sense of where we're going so we can plan accordingly to that.
Brilliant, thanks. And Phil, are you optimist or pessimist?
Probably somewhere in the middle. I don't know. I think it's extremely challenging for young people at the moment, and it's challenging for them to just make ends meet, let alone think about saving for the future. And that is a concern that the longer that continues, the more impact that's going to have. We all know about compounding effects, and I'd echo what Sam said about, I think trust in things like pensions needs to be restored. It's just not sustainable to keep changing the goalposts on these things, because there's a whole sort of movement for auto enrollment, getting people more into pensions. People aren't saving enough into pensions, get more into them, and then you're just pulling the rug out the other side. It's not building that trust, and And people aren't, I think there's lots of, I don't know the numbers on the studies, but more and more young people are opting out of pensions and not saving into them. So I think, it's quite a pessimistic view, I guess. But I think, there are a lot of challenges, and I think there's difficulty in building that long-term sort of cash or investments that people are going to need to retire. And lots of people, young people I've spoken to are like, well, I'll probably never be able to retire. It's a completely different makeup, isn't it? It's like, people are saying, I'm never going to own my own house. I'm not going to have a big pension. I'm not going to have all these things. And I think, what we're looking at as the people who are, retiring now, their asset makeup is probably going to be quite different to what we see for the next generation coming through, especially if nothing changes.
Absolutely, yeah. But I guess the theme coming out is, if we're going to prepare for the long term, we have to have a long-term attitude towards everything. The way we communicate with clients, the way we make policy, the way we incentivize people to save. It's that consistency and long-term attitude all the way through.
I think, I'm sure Phil would agree, so I don't put words in your mouth, but I would love to see financial education taught at schools. They're talking about, we'll change the ISA rules to make you can only put $8,000 in a cash ISA. That'll incentivize investing. Actually, I think if you showed a group of 16-year-olds compound interest calculator and just see if you started saving £10 a month from the age of 18, and if you put it into a standard balance fund, this is what it would do. And this is the past performance of these assets. You start to educate clients, give that sort of foundations. That's where outcomes come from. I think it's too easy to think that outcomes are always dictated from policy. It's not. It needs to be, as Phil said, I think in his first answer, it's a behavioural change is what we need to see. And that is where government have a unique ability to say, actually, we want to introduce it as part of a GCSE. We want to introduce it as part of a maths module. So we can still learn Pythagoras' theorem, but actually, this is what compound interest is. And this is what basic taxes are. And this is what the difference between a general investment and an ISA is. It's these little things that I think back to when I was as a teen and my mum said, you should open up an ISA. I said, why? And she went, it's tax-free. I said, but isn't my bank account tax-free? Oh, yeah, it is. So I just didn't understand it. But that's not to be unexpected because there's never been that education. So I'm trying to be more optimistic. It's sunny outside, feeling optimistic.
I guess that's it. The tools are there. And we can, we know what the right path is. So it's just a case of keeping everyone on it. Brilliant. I just want to say, Sam, Phil, thank you both so much for talking to us today on the podcast. Really appreciate your insight and time. Thank you.
Thanks for having me.
Yeah, thank you very much.
Cheers. Thanks. That was brilliant. Thank you for listening to this episode of the PFP podcast. To find out more, you can find useful links in the show notes. You can also explore related articles and more podcast episodes on the Personal Finance Professional website, many of which can be recorded as CPD and logged directly on the site with a click. If you enjoyed this episode, please like, review, and subscribe. Until next time, goodbye.